Silver's unleashed. Expect something extremely dramatic between now and the second quarter of this year. Why is silver confined for 50 years with a $50 cap? If it's no longer confined and going to a new reality, why maybe should not the spreads also seek a new reality? It comes up to much bigger numbers than merely going to 100 to double the range. And so I'm very appreciative of the attempt to sell it there. I cheered it because that told me these guys are playing the game of the arithmetic swing move. We're going to have a normal bull market. And I don't think they know what they're dealing with. Miners that produce the metal were worth 25% of gold for decades, and they went to 4, and you think they're going to go to 0?
I was there, man. They were worthless.
Yeah, you would think so. Well, what happened? They didn't go any lower, and for 11 years, they lived in this sleepy little range between about 5% and just over 8, back and forth. So it's like a box. If you saw the chart, you'd say, ooh, break out of that. That's a breakout. You're trying to break out this month. And if you do, that spread relationship says, I got no resistance above me until, heck, I go back to the old floor. And the reason I use XAU is it's both gold and silver miners, but it goes back to the 1980s, so it has a history. GDX only went back to 2006, for example. But anyway, that spread chart's breaking out, trying to this month. And it's tried a couple times before, so this probably is going to work. It's been multiple hits. And if it does, it says game just started. That's a fresh breakout.
Before we get started, this podcast is not investment advice, and I'm certainly not a financial advisor. Before investing, do your own research. Talk to a licensed advisor, and remember, risk is part of the game. It's a pleasure to welcome back to the show Michael Oliver. He's a veteran market strategist and the founder of Momentum Structural Analysis, best known for calling major market turns before they show up on price charts. For decades, hedge funds, institutions, and contrarian investors follow him because he focuses on momentum breaking first and price second. And that is exactly what he did in late 2025 before silver went parabolic. Michael, no one nailed the silver market the way you did. How do you feel right now?
Well, I feel like it's only just begun. And unfortunately, a lot of investors feel like, oh boy, this has been great. I got to cash out, Anyway.
Yeah. I gotta lay it out. So, you came on just over 3 months ago on October 17th and spelled it out in perfect English with a level of conviction and accuracy I just have not seen from anyone else in the space. Now, silver closed at 51.92 that day, and it didn't start really breaking out until early December. So you gave us some time. And, I was already long physical silver and heavy in the miners, but man, I wish I could go back to that day. For our listeners who missed that episode, go back and watch it. It's a true masterclass. Michael's ability does not come about after a few years. This is decades and decades, 40, 50 years in the markets. It's really a view into his mind and his momentum analysis, his systems, and just his patience and conviction. And I can't wait to ask what comes next.
Silver in 21 of those 50 years that we've had has at least been 2% of the price of an ounce of gold, minimum. And in bull trends like 79 to 80, or we're in a bull trend now, right? Okay. Or in 2010 and 11, silver was 3% or more the price of gold. So right now at 1.125, silver is very cheap relative to gold. But it's technicals of that spread relationship. And we study it, the week by week, month by month, and we run momentum of the spread. Momentum is now breaking out. It's telling us the spread itself that is rising, favoring silver since the beginning of the year, or especially since April, since April, sharply. It still hasn't broken out on the spread, but the spread, you get above 1.31% to get bean counting for you. Yeah. And we're headed toward that level. You're going to blow out a 3-year high on the spread, in which case you're going to rush. We're at that cusp right now, where if you go through that level that I just mentioned, and 1. We're nearing, 1.31, you get above that, there's a vacuum between you and 2%. And that's not necessarily resistance. That's just a level we've been at 20 of the past 50 years, okay? So it's hardly exciting to get there. But that is enormous. So that's why I'm emphasizing silver, because I think silver is vastly undervalued.
Well, Michael, it's January 27th. The spread broke out just as you forecasted. We're sitting around that 2% range. Gold's around 5,000. Silver's taken a momentary pause at about 105. We're sitting around 2%. First of all, congratulations on your call. Amazing work. And what do you see?
We're still early on that clock. The spread broke out, and how many months? Usually it's a couple quarters. The other instance was in 2010 to 11, a similar spread breakout for silver gold. And then silver launched. Okay. We also have done studies of other markets, and it's a rare event what silver's in right now. But I call it going to a new reality. So it's not a normal bull market. In other words, most people who look at this market on an arithmetic price chart on their quote screen, their jaws drop. Oh, wow. And every flicker, they feel like they've got to take profits. And I can understand that emotion, but all of our work, and it's not just that spread relationship, there's implications beyond that $200 even, indicate this thing's going to go berserk into a new price reality that is reflective of a lot of things that it hasn't done in the prior 50 years when it was confined in a box. Some other markets have done this type of go to a new reality event. Even copper. It lived in a price range that was dull for decades, between 50 cents a pound and $1.50. You go back to the 70s, 80s, 90s, 2000, about 2005, late that year, it punched up through the top of that bull price reality, and it quadrupled in a couple quarters. And there was no specific event that did that. Lead, another exciting metal, had been in the same kind of price range that it's an inhale, exhale for half a century almost. And in 2007, well after copper did its thing, lead broke out of the similar price pattern and quadrupled in a couple quarters. And then once it did that, there was a sell-off after that move, but it lived in a new average price reality that was quadruple the price level of the prevailing multi-decade range. So it's happened before. There's other markets I could cite. But when you look at silver, I know a lot of people treat it as an industrial metal. And yes, it is, okay? And it's got a supply-demand deficit, and that's helping drive it. But it's also money. Don't forget, historically, it's baby to gold. And gold hasn't been restrained in a 50-year range. You look at its bull peaks, 1980 when silver hit 50. 2011, gold was $1,900, well above the 850 high, 1980, while silver was still at $50. So what's going on? Silver's unleashed. Expect something extremely dramatic between now and the second quarter of this year.
So if the spread breaks and we drop below, say, $100, what are your expectations for a correction? We're in this new reality you speak of, but, how significant?
I expect the spread to go a lot higher than merely 2%. 2%, by the way, meaning divide an ounce of silver into an ounce of gold, express it as a percent. Most people do the ratio. We do it the other way. 2%, it happens to be so common that in 50 years of silver history, it's been at 2% of the price of gold in 20 of those 50 years. So it's not like a big event. It's like, oh, hum. Okay.
It's not expensive.
Yeah, and now it's not expensive. It's not even necessarily a bull market to get to 2%. In the bull years, which is 79 to 80, that actually been going up for years prior to that, but in that phase, it got well over 6%, 6.5%. Okay, and then in 2010 and 11, after years of advance, the spread shot up to 3.1%. Okay, we're just above 2% right now. Okay, you could go to 3% just to match the lesser of those two bull market peaks of the last 50 years in terms of the spread. 3%, wow. And gold's not going to sit still while silver goes up, by the way. So the spread doesn't work that way. Whenever that spread breaks out, you go back in history, you'll see gold was exploding too. It's just that silver was more parabolic.
Yeah.
And the other thought is this: why is silver confined for 50 years with a $50 cap? If it's no longer confined and going to a new reality, why maybe should not the spreads also seek a new reality? Meaning, take out where it was in 1980 at 6% plus or 3% in 2000. Maybe it goes even challenges those levels. You do the math.
Yeah. And I mean, there's arguments there. I think we spoke about that in October. I mean, adjusted for inflation, silver needs to go, depending on your measurement, to $150 to $200 just to match the 1980 high.
No, it could go to 500 if it matched 1980. So yeah. There's another argument for 500, by the way. Go ahead. You keep talking.
Wow.
Sure.
So with respect to the inflation adjusted, you're seeing up to 500?
Yeah, but there's another thing. Look at a simple price chart of silver, monthly bar chart. Go back to 1975. Mm-hmm. And any technician would look at that arithmetic scale, $4 to 50 and back down under 10 again, then back to 50. So you got like a range that involves $45 roughly. Okay. Yeah. If you add that to that range, orthodox breakout, it says $95 to 100 maybe. Okay. Mm-hmm. You'll notice we had a fight in the mid-90s, a week or so ago. It was for several days, a lot of selling there. I knew that crowd would come in somewhere, around 100 because they did their math. Okay. Right. The problem is, put it on a logarithmic scale. Mm-hmm. Like if you did that to copper back in 2005 to 7, put it on a log scale instead of arithmetic, then the quadrupling in price really was merely a doubling of the range in ratio terms. Silver's ratio from the bear lows to the bull highs for 50 years was a 10-fold advance almost. You're dealing with $4 lows and $50 highs. So when you went to the bottom of the range to the top, that's a 10-fold gain. Okay. Yeah. If you put that same chart on a logarithmic ratio scaled bar chart and measure the thickness of the range and simply add it to it, it says 500. Why not? Gold has done that. Repeatedly gone 8-fold moves. And right now we're only 0.6%, 60% gain, a 6-fold move as opposed to an 8-fold move.
I guess, taking the 1980 high, but I think some people would argue that, the low in silver was maybe $18, $20 when it was, 10 years ago, right? Or what have you, right? So that's a 10-fold move, takes you to 200, 180, 200, something like that.
Yeah. Well, I was measuring the entire 50-year range, and there were lows at $4, and I think the recent low was under 15.
Yeah,
the recent secondary low. But regardless, it comes up to much bigger numbers than merely going to 100 to double the range. And so I'm very appreciative of the attempt to sell it there. Mm-hmm. I cheered it because that told me these guys are playing the game of arithmetic swing move. We're going to have a normal bull market. Yeah. And I don't think they know what they're dealing with.
Yeah, there's always resistance at those key levels, right? And there was, you're absolutely right. So you did a pretty good job there, but I think some people, like you just said, they need to be sort of convinced that this isn't 1980 or 2011 and that silver is going to crash by 80%. When does this move over? And again, you're just relying on momentum. Are you looking at, I know fundamental demand, you don't so much worry about that, but.
Yeah. I'm looking at the comparisons to gold, for one thing. We're still undervalued. Okay. At least go to 3.1 to match the 2011 peak. Heck, we blew out that price high. Why not challenge the spread? Maybe challenge the 6%. And then when you look at gold, the mama metal, monetary metal, and look at the two prior bull moves, 1976 low to 1980 high, which was an 8-fold dimension move, 8 times what the low was. In 2001 and 2, it bottomed around $260 and had an 8-fold gain to its 2011 high. Longer time span, same multiple gain. Our low was 1,050. Bear low in 2015. That says $8,500 gold on a ratio scale gain is merely reflective of what it's already done twice before. So it's not even a big deal. Oh, I did that twice before. I'm going to have another 8-fold. The difference now is there's other stuff going on, as you know, and your audience probably knows. We've got a government debt market crisis. We didn't have one in 2007-8. We had a mortgage crisis. 2000 to 2002 bear market in stocks. We didn't have a government debt crisis in Japan, here, UK, whatever. We had a dot-com bubble, okay? Very sort of localized events. This time we have something. You look at the T-bond chart, you know there's something wrong there, and it's bigger than the stock market. And what's his name? Williams, the president of the New York Fed, I noted that back in November, mid-November, he made a speech or a press conference and said, the Fed is now going to start buying bonds. And he said the reason for that was, just to provide some liquidity to the market. Okay, that's a nice way to avoid that he's panicked. Okay, so they've been buying bonds, you can tell, since then. But what's happened to bonds since then? T-bond futures, look at the 30-year futures. They were in the 117.18 level when he made that statement. They're now in a rally mode in the 115s. And they dropped ever since now they've had this very unusual floor under the bonds. If you look at the price action of T-bond futures, especially over the last 2 months, Dec and Jan, they've been confined in one of the narrowest price ranges you've ever seen. It's almost like it's asleep. You can't find a period in history where T-bonds were ever that squat on the ground, and yet every rally just couldn't go anywhere. The Fed's buying it, so that explains sort of why it's not going down, but they can't get a rally going. We've got some technicals that say, yeah, watch gold and silver, but you've got to watch these other markets, because if that T-bond market slips about 3 points below the recent lows, no big deal. Mm-hmm. We're going to break some momentum stuff that says you're headed for a mini panic.
In a world of rising deficits, currency dilution, and market volatility, many U.S. investors are choosing to diversify their retirement accounts with assets like physical gold, silver, and even crypto. This video is sponsored by iTrustCapital, which offers a platform for Americans to hold physical gold and silver, as well as crypto, directly inside a tax-advantaged IRA. Designed around transparent pricing, with clear premiums over spot and no hidden storage fees, iTrustCapital offers something that still isn't standard in the precious metals IRA space. If you're a U.S. investor looking to learn more about owning gold, silver, or crypto inside an IRA, use the link in this video description. U.S. residents may be eligible for $100 funding bonus when opening and funding an account with iTrustCapital. Now, let's get back to the pod.
Okay. Now, we know the Japanese already having one. Okay. Yeah. It's not just us, it's them. UK's not good. Hey, this is the Western world's crisis.
Yeah.
And, there's only one way out. Print, print, print. And, what does that do to gold? That's what it lives on.
Yeah. Sends it into the sky.
Yeah.
Yeah. Ascent was just commenting about Japan. The other 2 days ago. Yeah. How do you see that crisis unfolding? We talked about a stock market top. That's one of the next things I wanted to sort of get into, in that, in 08, and oftentimes when you have the market collapse, it takes down the miners, it takes down the metals with them, at least, for a period. Mm-hmm. Do you see something like that happening if the NASDAQ and some of these, roll over?
Yeah. I think the stock market is topping. We've been arguing for about 3 months that it's going to go higher, meaning between now and January, maybe February, it's going to make a new high. That stupid 7,000 level on the S&P, that like 6 months or 4 or 5 months in a row, they're 69 something, 69. They can't seem to get to that magic number.
Yeah.
And I'm sure they're going to blow through it. But it's part of a topping process by our assessment.
Yeah.
Higher high than early 2025. By 10, 15%. Similar action occurred in the year 2000, by the way. Also in 2007, there was a high, looked like the top for a lot of people, dropped, made a new all-time high. That was the top. But the stock market does not look like it's in a crash situation at the present time. It looks like, yes, you can roll it over and maybe have a few slabs of even double-digit climb, but that's not what upsets the miners. Back in 2008, and by the way, there's other technicals that argue this point. First off, it's rare when you can connect the direction of the gold and silver miners with the stock market. There's plenty of times, 2000, 2002, when the stock market was in a bear, no crash. Miners were advancing. Okay. I remember back in 87, I wasn't looking at miners, but we had the crash in 87, which I happened to catch in a light way. Gold had an up month that month, about 7%, I think. Stock market was down about 35%. All of a sudden, going up. Okay, so don't make that connection. And there's also a spread reason not to. Spread meaning a relative performance. Back in 2008, in September, 1 month before the S&P crashed in October, finally, after a year of decline, it finally did have a puke month, over 30% rapidly. The miners broke too, but the spread relationship at that point in time, when you plotted the XAU index versus gold, they'd been performing par with gold for decades, on average around 25%, meaning if you took XAU, gold and silver miners index, and divided it into an ounce of gold, you would see that for decades it oscillated either side of 25% of the price of gold. Up and down, above there, below there, but in a range. Par performer for decades. In September 2008, the miners broke below the floor of that spread chart, took out decades of lows. The month before, S&P broke and the miners joined them because already the miners were saying, something's wrong. I broke down versus the mama metal. Sure enough, they suffered far more than gold and silver did during that October break. And they didn't come back so well, the miners. The opposite situation right now is occurring. They're breaking out upside versus gold, XAU index, from extremely low levels. So I think it's different this time.
Yeah. And I mean, '08 was contagion and, just mass panic. And I mean, obviously we could see that again. But let's talk about the miners because they typically outperform, the metals 3-to-1 in bull markets. We're starting to see that for sure. They're outperforming. Do you expect that to continue? Like, how are you playing this as the bull market matures? How are you playing it?
Well, see, that situation is just beginning. It's sort of like the silver versus spread relationship, where all these things have been going up for years. Miners, gold, silver. They've recently changed the dimensionality and the tone. Silver changed because its spread broke out versus gold back, late last year. And bang, bang, bang. All of a sudden, the spread exploded, but also silver went off the page compared to gold. The miners have been, after that collapse that was signaled in September 2008, the spread at that breakage point was at about 17%, meaning you just blown out all those lows of that you collapsed to 4% by December 2000. Think about that for a minute. Miners that produce the metal were worth 25% of gold for decades, and they went to 4, and you think they're going to go to 0?
I was there, man. They were worthless.
Yeah, you would think so. Well, what happened? They didn't go any lower, and for 11 years, they lived in this sleepy little range between about 5% and just over 8, back and forth. So it's like a box. If you saw the chart, you'd say, ooh, break out of that. That's a breakout. You're trying to break out this month. And if you do, that spread relationship says, I got no resistance above me until, I go back to the old floor.
25.
No,
Michael,
that's the average. I'll take the floor. This floor was 17 to 18%. You're at 8-something. That's more than a doubling. More than a doubling.
Wow. Let's talk about this. Let's talk about this because the miners have had a huge move, right? The GDX is up, it's up 200, 300% in the last year.
More than gold over the last year or so,
But I love this because we're back in the spread world, which is your world. So they're at about 8% right now to the XAU. And
the XAU is about 8% plus 8.6 approximately versus gold price.
That's what I mean. Sorry. That's what I mean.
The reason I use XAU is it's both gold and silver miners, but it goes back to the 1980s, so it has a history. GDX only went back to 2006, for example. But anyway, that spread chart's breaking out, trying to this month. And it's tried a couple times before, so this probably is going to work. It's been multiple hits. And if it does, it says game just started. That's a fresh breakout.
You gave us the exact spread. 1.31 is like burned into my brain for the rest of my life. What is that number for the miners?
Well, 8.62, like to close a month above that number. And we've been trading above it on and off this week, and we got 3 days left.
Yeah.
Let's see. Now, if it doesn't do it this month, I'm betting it still does it like next month. Because
So you divide the price of XAU by the price
just
of
take
gold.
XAU and divide it into gold. Yeah.
XAU divided into gold. Got
And
it.
the end of the month, the closing Friday, in other words.
Okay.
And right now it's at breakout levels, but you never know. It might be just below, just above. Now, if it doesn't this month, don't assume it's going to fail, because when you see this pattern develop with so many hits to the top of the structure, it's so clear. It's showing intent, and also put it into context. I mean, everybody wants gold now. Not everybody, but a lot of people do, and they suddenly realize they need silver. But the miners are gonna stay cheap. I mean, even 8% is like compared to an average price of 25%. I mean, it's off the page cheap, and that will surprise people because for the fear factor that you mentioned. Oh, if the stock market rolls over, we're in an opposite technical situation now, and cheap, just like silver was to gold early this year, 1%. So pay attention to that. And
Incredible.
It's fresh, meaning if that breakout occurs, it's saying something's not about to end; it's just beginning.
Yeah.
So.
And I think it'll catch a lot of people sleeping because they've got recency bias, right? They've been looking at the miners, but at some point gold they're going to say is too expensive, and it goes down the value chain, right? Now silver's outperforming; it'll be the miners' turn. Yeah. You talked about a gut kick, something coming that we don't expect that's going to derail the markets. You mentioned the financials. Are you still a little bit cautious there? Are you seeing anything there?
The financial sector is the most anemic right now, one of the more anemic sectors. I know everybody's looking at AI, and it's not back to its highs, by the way. So there is sort of divorce there. The leader isn't suddenly the leader anymore. And if you look at commercial real estate, which is known as like a comatose market, still where it was 10 years ago and has not made new highs versus 2022, heavily in debt. So long-term debt rates choking them. Then look at the XLF, the financial ETF. Yeah, it made new highs recently, but timidly. And it's very vulnerable technically to a downturn. I'm not arguing crash. I'm just saying, downturn.
Yeah.
The crash potential for the stock market doesn't even occur this year until we get down around 5,400 on the S&P. And I think the process of getting there, now that number doesn't mean much in a price chart because the low in April was 4,800. Okay. But my long-term momentum stuff says you don't believe you see 5,400 again. Okay. Well, you say, well, so what? It's 1,500 points below. Well, that's a nice double-digit percent. But I think the process of getting there is not likely to be sudden. It's more likely to be an arm wrestling event. And remember, the stock market in 2007 through 9 spent a whole year of arm wrestling decline before it finally had a puke. And again, that relationship's different anyway now between the miners and the S&P. But I don't think you're going to have that kind of drama. And plus, I think the Fed's going to be accommodative. So they know this is going on. So they're not just looking at the job market. They're nervous in the background by another mandate. It's called government debt. And they don't want to speak about it because that would, accentuate it too much. But you can't have a debt crisis in Japan and near a debt crisis here because of the process of multi-decade continuing to push it off. Even Jamie Dimon said months ago, you can't keep pushing this thing off, this debt government spending thing. You're ultimately going to have a problem.
Are they just going to devalue, Michael? Rick Rule is expecting 75%, decline in the dollar here.
Well, it's starting to even break for the price guys. Momentum of the dollar index broke in March of last year at 104. We would turn bearish then. It then dropped to about 96, 97, 98 and lived in a zone for 9 months now. Now we're back down in the 96s as we're talking. Okay. Yeah. You close a month down here and even the price guys, which haven't broken their trend line. You look at a price chart of the dollar index going back to 2010, you can draw an idiot line up under multiple lows. And they've been buying it on top of that trend line like 9 months now. Like, oh boy, I know where to buy it. Okay. It's not rallying. It's just hugging the line.
Just bouncing a little
Anemic,
bit. Yeah, small
Meanwhile,
bounces.
all my long-term momentum metrics, 10-year average oscillator, 3-year average, they blew their structures last year. And they're congesting below the breakage point. So they're already broken. Momentum usually leads price. And I'm suspecting when the price gets down where it is now, close the month around here, you're going to upset some price guys. So the downside of the dollar is then going to pick up some steam and become a factor again. You know,
do you have some targets for the DXY?
I think the dollar could go take out the old lows at 70, that it saw back in the last major low. In fact, if you go back and just look at a dollar index chart, which really is, I don't know why people look at it, because what it measures is one piece of fiat versus a couple others, And mainly the dollar index is over 70% of it is euro and Japanese yen combined. So it's really, like an index of the upside down of those two currencies. And, how can you praise them?
Well, I was going to say,
boy, I love the yen. It's ridiculous. Or the euro.
Yeah,
it's like one piece of scuttle.
Might be the only two places in the world that are worse than the U.S.
The real way to measure dollars, look at an M2 chart. Mm-hmm. The ongoing degradation by the explosive growth in the money supply.
Yeah. So you kind of look at that for guidance. Do you think the dollar bottoming in the low 70s, like we saw, or going down there, will obviously coincide with a peak in gold?
No. The correlation between dollar's major trends and gold is not good. Now, I'll give you an example. Right now, you're about 1 point on the dollar index below the price level that it was in December of 2015 when gold bottomed at 1,050. Back then, the dollar index had been in a rally mode and was in the upper 90s, 97, 98, later, December 2015. You can draw a line on the dollar index through the decade plus, either side of that 97. Yeah. Well, we're there right now. So if you looked at the dollar index, you'd say, well, gold's probably unchanged too, right?
Yeah, everything's fine. But there is one exception to that. I mean, it's kind of like in 2011, the dollar was under pressure when gold had its former peak above 1900.
Yeah.
But other than that, the correlation is limited.
I think the dollar breaking will help accentuate gold's acceleration. But I think, again, the monetary metals are likely to do most, I'm not going to say all, but much of what they might be going to do by middle of this year. Silver especially. So if it's going to a new reality, which I argue it is, and there's multiple technical reasons even beyond what we're talking about, if it goes to several $100s and puts itself in a more proper relationship to an ounce of gold, for example, and gold's going up during that time too, a lot of that's going to occur rapidly. It's not going to say, oh, boys, you guys could get on any time in the next few months and get on board this nice train. No, if you're not already on, based on the spread breakouts, which is like the final signal, or in the case of the miners, if they break out versus gold, that's a fresh green light. But don't wait a year to find out. Okay.
Yeah.
I think a lot of it's going to get done very rapidly. And it's a good chance that monetary metals are coming back as a currency after the next global debt and stock market crisis creates uncertainty, fear, emotion, and ripples into political effects and impacts central banks as well. Already we know the prime minister of Japan, who just got elected some months ago, the woman, she used the term, she's replicates herself as a Trumpist. She is. She said, we're going to print. Whoa. But that's not free market. And then Trump wants to put the guy there who's going to print too.
I know.
So.
Yeah. So you're arguing, I mean, we've seen the unit out of the BRICS, right? That's going to be 40% backed with gold. You're sort of arguing here, Michael, like to reestablish confidence in the West in any currency, there's going to have to be a component of precious metals, and that's going to kind of support the new reality.
We'll be lagged to reality. There's no question. I can tell. The Western world will be lagged to reality. Yeah. But it will come because if the crisis hits as we see it, a major stock market decline, particularly in the U.S., we're the bubble. Europe's not so much as a bubble as we are in terms of stock market. They're a debt crisis just like us. But you combine a government debt crisis and a stock market breakage. And all of a sudden, and there's another factor here. Commodity market's going to turn up, and it's turning up. In fact, we turned bullish on the Bloomberg again after we turned bullish late 2020 before it exploded, it doubled in price. Still only half the price it was in 2008, by the way. And then it had a retreat into 2023, 24, and 25, where it just laid dead around 100 on the Bloomberg. You broke out in October on annual momentum. Price then was 107. Right now we're 121. Nobody's noticed that it's turning up because it hasn't done it with a headline or a big event. And it's a combination of here, there, little pieces here and there of this commodity, that commodity.
Yeah.
And
lithium.
that guy's turned up again. So you're going to have not only lack of confidence in government bonds, lack of confidence in the stock market, especially once you wipe out the 2025 gains, which is only 15%.
In a world of rising deficits, currency dilution, and market volatility, many U.S. investors are choosing to diversify their retirement accounts with assets like physical gold, silver, and even crypto. This video is sponsored by iTrustCapital, which offers a platform for Americans to hold physical gold and silver, as well as crypto, directly inside a tax-advantaged IRA. Designed around transparent pricing with clear premiums over spot and no hidden storage fees, iTrustCapital offers something that still isn't standard in the precious metals IRA space. If you're a U.S. investor looking to learn more about owning gold, silver, or crypto inside an IRA, use the link in this video description. U.S. residents may be eligible for $100 funding bonus when opening and funding an account with iTrustCapital. Now, let's get back to the pod.
Yeah, picture yourself as an average American with his retirement account. And he's smiling because he says, well, if he replicated S&P, he's smiling. 2025 produced a 15% gain. Not much, but up. Yeah, nice. He smiles. Okay. You suddenly take that away in 2026, 15% drop, and get back to where we closed, 2024, wiping out 2025's gains. And suddenly it's not going to look or feel good. And that's his only positive right now. Commodity prices, consumer prices are hurting. He's late on his credit card. He's asking for delayed payments on the IRS. You take the stock market down, you get emotion, and that has political central bank consequences. A lot of stuff could happen quickly.
Have you looked at the Canadian markets? You talked about Europe being not so overvalued as the US. How's Canada? I mean, we're a commodity.
I haven't looked at the currency lately, but the commodity-based currencies, like, for instance, Australian dollar and Canadian, look to fare well versus the dollar index. And because a lot of their stocks are commodity-based and related, that could help their stock markets as well. Not that it guarantees they're going to go up, unless they're overly weighted commodities, because commodity stocks are going up with commodities. But, the broader Canadian index contains a lot more than just ag-related or metals-related stocks. So it might just go down less than the U.S. stock market. But it's a better place to be if you got to be in one. You want to be in commodity-related stocks, like energy-related, base metals, ag-related. And those will do well, net price. They'll actually go up because they do not correlate to the S&P. Historically do not. So don't be fearful of that. Just like gold miners, I think will, et cetera.
Yeah, outperform. I saw even in the U.S., the trade deficit declined dramatically because of all the gold that they're exporting.
Yeah.
So Canada, that's what we've got going as well. I mean, we have a huge export of gold. So anyways, we got to talk about Bitcoin. It seems like the crypto space has been left for dead. You called it. Like the old debate, granddad's going to win, and it's been a knockout, the last few months. What do you see, happening with that space? You've
had your initial break. We run a lot of long-term momentum charts of Bitcoin, arguing that during that last surge, we got the 127th on Bitcoin, made new highs. Everybody cheering, going to go forever. The $5 million, whatever.
$1 million.
So, whatever. It's all these headlines. And then suddenly it collapsed down to near 80, like boom, okay. Well, momentum said, you're done. It was arguing all along that's going to fail. And the trigger levels were up 104,000 was one of my primary trigger levels. So 82,000 low. Okay, now, since then we've had congestion, and that makes sense to us technically. We argued you probably will have congestion. It might even last another month or so, where you get this up-down holding action, anemic but holding. Ultimately, I think you're going at least 60,000 on the downside. Well, you can say, well, that's better than 10,000. Well, yeah, but you wipe out everybody for the last umpteen years is just wiped out.
Yeah.
And we ran charts the other day of the spread relationship or relative performance of Bitcoin to gold and Bitcoin to silver. And you look at what happened, even before the momentum breakdown in Bitcoin and the price breakdown, the spreads broke, meaning the uptrend that people thought that Bitcoin's going to go forever, it broke its relationship to gold and it collapsed. Combination of both Bitcoin going down and gold rallying. And those charts are just devastated. So the argument that, oh, this new thing, it's the new money, just got trashed. And I don't think it's through. I think we're going at least 60,000, maybe
lower. Yeah. And you think what? It could base around there for a little bit, consolidate?
Oh, I don't know. I'm not sure it's even going to hold there, but it's a swing objective. And frankly, even on long-term momentum, that's a shallow target. It's not really, I'm not arguing. I could see a lot lower, but I'm not going to get outlandish. I do think you'll at least see 60,000 in the next leg. I suspect the next leg you'll see well underway later this quarter, early next.
Yeah. I just want to come back to the sort of immediacy of your forecast. Like in October, you said within the next 6 months, and you've repeated throughout this conversation that, silver and gold, like the breakout is going to happen quickly. Is that just because historically, when it kind of goes through that level, it always happens pretty quickly?
And plus it's at a low level. In other words, you're looking at a metal that historically, when it was near it was below 1% actually early this year. When you look at that historically, go back 50 years, I mean, you think it's going to zero? You buy cheap, okay, but you needed a technical signal to buy because it's been cheap for a while. So, you can't just say, well, it's cheap, I'll buy it. Well, like the gold miners have been cheap to gold, but for 11 years. So the question is, when do they finally decide to wake up? And when they wake up, you better pay attention because, they're still cheap, silver to gold, miners to gold. Yeah. And when they come out of there, if that was a mistake, an underpricing mistake, and it prevailed way too long, then often the compensation for a market mistake is to compensate for the mistake, but overcompensate. So if it's fundamentally justified that silver, let's say, I've said this before, gold goes to 8,500, it matches the prior two highs in terms of dimension. Okay, let's deal with that. I don't think it's the top, but if silver were 3% of that, that's 240. Okay, if it were 6% of that, you get the point.
Yeah.
Okay.
500.
The same with the miners. So you've got to get on board when they finally say, okay, yes, I've been cheap too long, I'm going to have a tantrum the other way. And I bet they overshoot it. So like if silver should be $300 and gold, 8,000, let's say, and the ratio is more normal. Do you think it's just going to go to normal? No, it's probably going to overshoot it.
Yeah.
Again, and just like making up for the mistake it made. Markets aren't rational.
No.
No.
Especially with all these other factors involved.
Yeah.
Michael, some people are, scared to sell their silver because they're worried, of a financial collapse and needing it, to barter with and basically buy food and things like that. In terms of exit strategy and how you kind of do that, do you think it's going to be kind of rocky? Like obviously the debt crisis at some point, the dollar crisis is going to, all these things are kind of coming, right? Like in 2008, it was very different. It was kind of world, but America is really in many ways at the center of this crisis. What advice do you have?
The stock bubble and the government debt bubbles combined. We're arguing that there's likely to be, in the middle of this couple quarter explosion in silver to a new reality, a month or so, handful of weeks at least, probably a month, where it feels bad, where you get a reversal, where you get what looks like a top to every guy out there who's been yelling top all the way up. Finally they'll get one that will look more like one. They thought it was a top the other day too.
Yesterday, 117.
2 weeks ago was a top, and a month ago. But there is a level, and I don't have it defined yet. I've got some parameters I'm looking at, MSA is looking at, that could suggest, okay, we're now at certain levels on these indicators that suggest be careful of a midpoint fake out false correction. Mm-hmm. In fact, if you go back and look at the 79 to 80, summer 79 to 80, or look from September 2010 through April 2011, where silver went parabolic in price, there was in the middle of both of those, roughly in the middle of the clock, the 79 to 80 was 5 months surge. Mm-hmm. The other one was 7 months surge. So either side or 2 quarters. But right in the middle of both of those, there was, in fact, a month that looked like, oh, gosh, that's it. Yeah. And it was a total fake out. And it marked the middle of the clock, but it didn't mark the middle of the price move. Because what occurred on the other side of that, once the fake out breakdown reversed and took off again, was more on the upside than what preceded it. Okay. The question is, where's that midpoint going to be? Is it going to be 120, 130, 150? I suspect, and this is ballpark, so don't act on it. Yeah. Our reports will try to get as specific as we can, and maybe we'll miss it. But I think somewhere probably later in February, maybe early March, there will be that wobble. And that's where, especially, now if you're an investor, forget it. Don't get out. If you own bullion or miners outright, you're not leveraged. But if you own like call options, or especially futures or double long silver ETFs, you might want to get cautious and protect. Partial protection, not all. Don't get out of the market. But there's likely to be that kind of jiggle. But on the other side of that, I think that's where you see the new reality reached, which will drop jaws. Especially if you fake them out in the middle, because that's going to shake out a lot of people. And then if you shake them out and turn up again, either they're not going to buy back or they buy back again.
Big.
And that's also probably when you're going to get some stories.
Yeah.
Some explanations about why now, hindsight analysis. And then people say, oh, okay. Yeah. Pardon me for going on.
But this is great.
Let's say you're a portfolio manager in a family office, okay?
Yeah.
And you've been getting emails and phone calls from your clients for the last 3 or 4 months saying, should I own some gold and silver? And you're not a gold guy. You don't understand the fundamentals of it, really, the monetary aspects. You don't see what we're talking about. And you say, well, I don't know. But suddenly when you start to get earnings reports, and as I understand it, in this coming month in February, there's like 4 of the biggest silver miners are going to report in the first 2 weeks. Of course, they're going to report on what? Fourth quarter. Well, if you look at silver's average price in the fourth quarter, it was, nice high for 50 years. It was like $50 or so. And you know darn good and well that their earnings are going to look real good. They've been making a lot of money. But the reality is now we're dealing with $100 silver. So even those earnings numbers are next to meaningless, okay? And true with gold miners too. Okay, yeah. All of a sudden then when you start to get these these earnings reports, the orthodoxy type stuff that these guys will act upon, that's when your portfolio manager, your financial advisor will say, yeah, Joe, I think it's a good idea to own some silver and gold miners. And so the mob's going to come in when? Very late in the game, based on the normal metrics. Yeah. Which are lagged to reality. Okay.
Yeah. Once they have those financial statements to point to and they can see $1 billion in free cash flow, $2 billion in free cash flow, it's going to be very hard to argue. With it, right? And you as a portfolio manager, if you don't recommend it and your competing portfolio manager has, his clients are smiling and yours aren't. Just lastly, Michael, 2026 is underway.
Yeah.
If you're right and stocks roll over, the dollar breaks down, what key signals are you looking for, as they relate to the continued acceleration phase? You're watching the XAU, 8.62. Is there anything else?
You get above that. That's a key for me, is that because that tells me, and Barty, my personal portfolio, what I've been doing is slightly lessening up on call options at this point and moving straight into miners.
Okay.
And SIL, for example, the mining ETF, which is silver miners.
Yeah.
But also buying a lot of junior miners and so forth outright. And I've got like a dozen to 15 mining stocks, including 4 of the biggies.
Yeah.
So I'm starting to shift more into the miners because my assumption is that breakout's coming. You're not going to stay in the box. Silver did it. Miners are going to do it too. And they're dancing either side of that number right now. If they do it, there could be a gusher. And probably a lot of that gusher is going to occur before you ever have an event in the stock market, for example, let's say mid-year. Heck, by then, where are the miners going to be? Where might silver be by April, May, June? It might already have accomplished much of what it's going to do.
Yeah.
Maybe the gold and silver miners will have already doubled in their relative value to gold and be bumping the underside of that multi-decade prior performance action. So a lot of it could occur like in the next handful of months. So I'm making that shift, de-emphasizing gold bullion, emphasizing silver, especially silver miners.
Yeah. As always, Michael, I just want to say again, thank you for your time. Thank you for coming on, and congratulations. I can see the enthusiasm and the excitement, that you really believe the best is yet to come, despite the incredible move we've had. I just enjoy it, man. I can tell this is your life's work. I think,
this is a lifetime experience because this is a rare event. This is
really
not a bull market, and I know that. And therefore, I've reset my mind not to treat it. In fact, if you use the old metrics, even some of our momentum metrics get overbought, I'm learning to discard them. So if you use something like monthly RSI, like silver, for example, even back in 79 to 80 in that explosion, RSI got overbought for a year. And if you used it to get out, you miss the entire move. So that's abnormal times.
Right. Yeah, the old metrics just don't hold weight.
This is different.
Anyways, MSA, is that the best place for investors to find you and subscribe to your work?
OliverMSA.com. OliverMSA.com. Request some samples. We'll be happy to send them. Yeah.
Wonderful. We'll put a link in the description.
Thank you.
Again, I just want to say thank you. Thanks for sharing your work with us and the investing community at large.
Yep.
Really appreciate it.
Thank you, Alexander. Thank you.